Okay, welcome to Greatest Hits, a review part 2, and more importantly, how to strategize for possibly imminent tax law changes. We're looking at many of these tax law proposals. It can make your head spin. It can make you nervous. It can make you uncertain. But what we want to do today is give you some ideas of what may be happening. And the first rule here is don't overreact, because there's a good chance that almost nothing will happen other than putting the tax law back to what it was when Donald Trump was elected. And we know what that means. We know it means a 39.6% income tax rate for individuals, a higher income tax rate for corporations, but there is talk of a lot of pretty interesting and pretty intense changes. So I'm here on lucky slide 13. People ask me all the time, what do you think the new tax law will be and when will it be effective? And the two answers are, I don't know and I don't know. But I feel strongly that because the senators and the congressmen would like to be reelected, that there is not going to be a significant retroactive tax law here. I think we're going to have some notice of what's going to happen. Now, traditionally, when a new tax law comes out of the House Ways and Means Committee, which is where all tax legislation has to start, the effective date will often be January 1st of the next year, or will sometimes be the day it comes out of the Ways and Means Committee. But that's assuming that the House and the Senate and the President all agree that they want it to be retroactive. So point number one here is it's anyone's guess. Point number two is we are seeing, and you will always see, people try to profit from fear. And we already have clients and other professionals who have been approached with things that you really should do because the tax law is going to change and this will be better than that. And let's not overreact here. For most clients, it's business as usual. And what you have been doing and what you are doing based upon today's tax law is probably just fine. So number three, keep enough cash to pay your taxes. Quite likely taxes are going up. And if your standard of living interferes with your ability to retire because you're not saving enough, this is not necessarily a time to splurge. Yes, the markets are cranking out rates of return, which really cannot be continued. Real estate way up. Everybody's feeling really good. This is almost what it felt like in 2007, 2008. So let's please be conservative and remember that we are in completely uncharted territory in this economy with a lot of debt. So keep your cash, make sure you know where your cash is. The last recession, we had a lot of businesses fail that quite candidly would have thrived instead of failed, but they just didn't have cash and they didn't have control over their expenses. Number four, the estate tax is certainly not going away. Taxes are not going down. We still, and you know who you are, you're out there. You just haven't gotten around to it yet. You've got that 20, 30, $40 million net worth. You've got simple wills with maybe an AB trust, and you just haven't gotten around to planning yet. Well, we do suggest that you get around to it because remember, under the Bernie Sanders bill, what was he going to do away with? He was going to do away with gifts exceeding $1 million. He was going to do away with the ability to gift to a trust that's disregarded for income tax purposes. He was going to do away with the ability to make a sale to that type of trust without paying income taxes. He was going to do away with the ability to take discounts that we could typically take. And he was going to grandfather everything that was already in place. So it does make sense to get it in place now. And although there are people out there saying, well, if I give 10 million today and they reduce the exemption to 5 million, will they tax me on a $5 million gift? Will this be retroactive? And I don't think it will be. I think there's a greater chance that you'll be struck by lightning twice. Now, we can't promise that, but now is definitely the time to act. Another reason for that is that if we end up with a Canadian style capital gains on death system, which is not unlikely, it looks like it could happen, it would plug the budget gap very well. Things that you gave away before the effective date of that type of law would be grandfathered. So if you're in doubt about whether you should put some assets in an irrevocable trust to avoid estate tax or sell assets at a discount, boy, it's time to get it done. And number 5 here on page 13, using that Biden two-step, as we called it, and there's videos on it and articles about it. You can email us and we'll send you stuff. Biden two-step. Step 1, get an irrevocable trust, give it a seed capital gift of some amount, sell it, discounted assets in exchange for a note. Step 2, you can forgive the note. So that's number 5. Now, and that's number 6 also. Number 7, be charitable, because being charitable could save you a lot of income taxes, especially if you use a charitable remainder unitrust called a flip NIMCRUT, where, for example, a client is selling a property for a couple of $1 million and it's mostly profit. He puts that in a flip NIMCRUT, which is going to pay him up to 11% of its value per year for 20 years. And in year 20, what's left, which will probably be less than 10% of the whole arrangement, is going to go to his family foundation. Now, he will not have to pay any income tax on that sale until he decides to open the spigot, as they say. So without going into too much detail, he can defer those income taxes not only this year, next year, the following year, safely for up to 15 to 16 years, not pay any income tax in exchange for a little bit of complexity and something going to charity. Brandon, you want to pick up number 8?
Yeah, just a comment on the use of a charitable remainder trust. Even if you don't use the NIMCRUT mechanism and you have this as just a traditional CRUT that would pay 10 to 11% each year, that could be really important going forward as well, because a lot of these tax rules that are coming into play only apply at certain income thresholds. So if you take, one year's of income and spread it out over 20 years, that's going to help you possibly stay below those thresholds. And you can do the same type of thing, as we mentioned here in number 9, with an installment sale. You could sell assets to a related party for an installment note and spread out the income over the payment of the note term. There is some rules that you have to be aware of when you do this to related parties. There's issues with depreciation recapture. You can't resell the asset within 2 years. That triggers like an acceleration of the note for tax purposes. So there's some rules you have to abide by, but this deferral of income, spreading out income, that's all going to be very important if we do get some of these rate changes. Number 8, if you have a 1031 exchange in place, go ahead and try to get that done. There's mention that 1031 exchanges may limit gain deferral to $500,000. So your traditional large 1031 exchange may not be possible next year. So if you are considering that, go ahead and get that taken care of and in place prior to any tax law change. Number 10, if we do get changes, be ready to accelerate income this year. As Alan says here, work harder this year, take your vacations next year. I mean, we're in the middle of a pandemic, so I don't think a lot of people are vacationing a lot anyway. So, take advantage while you can. Recognize income this year if you can. All planning for a potential rate increase in the following tax years.
And we should know by December 31st whether you want to trigger income tax on all of your accounts receivable, or whether you want to accelerate deductions, because we may see next year that deductions are limited to only applying to 28% of income as opposed to against all the tax bracket itself. So remain flexible, hold on, don't act too soon, but stay flexible. That's for sure. Like yoga and Pilates, think that way. Number 11, again, that's more of the same. You know, every year at the end of the year, we have clients who struggle to get a big tax deduction, and they buy airplanes and they buy charter boats. And you can do that and get a Section 179 deduction on the entire airplane, the entire charter boat. In fact, the lawyer I work with had a client, I think it was last year, bought a $345 million charter boat and wrote off $345 million. And then you can later convert it to personal use if you follow all these arcane, complicated rules. But one rule may be that you need to have a certain number of hours in the transaction, like 500 hours. So I could see spending 500 hours selecting a $345 million boat. I could see spending 500 hours selecting a $2 million airplane, but you can't do that. You can't do that the last 2 weeks of December. So you've got to be planning ahead on what you're going to do. Now, Section 13. Right now, you can put assets into an irrevocable trust, and that doesn't trigger gain, even if it's taxed as a separate complex trust. And you can pull money out of a complex trust, and that usually doesn't trigger capital gain. But if you do that with a corporation, you would trigger gain when you put it in, unless you qualify under 351. And you do pay taxes when you take appreciated assets out of a company as if it was sold. Well, they may do that to irrevocable trusts. So look at your situation. If you're a client of ours, let's look at the chart together and decide whether you want the items in the trust now to be swapped for other assets while you can. So that's a good updating. By the way, I saw one discussion where the possibility of losing your grandfathering as to a trust by adding something to it now in case the law dates back to before you made the transfer, and therefore you should set up a new trust. And I think that the expense of doing that, if you already like your old trust, probably doesn't outweigh the cost. But if you have trust protectors who could just do a quick action to say that this is two separate trusts, one from the past and one that's doing what's doing today without much extra work, you can always merge them together later. But that's one consideration that might come into play. Brandon, what else do you see?
Yeah, and I think we talked about, recognizing gain, deferring potential losses. That's all just a play on the rate brackets. If they do go up or down, we want to maintain flexibility to try to recognize at the lowest bracket or push deductions to a larger bracket if we could. There's a possibility here we can make donations to a donor advised fund, private foundations. The same rules still apply where we have a large standard deduction now. So your charitable contributions have to exceed that standard deduction in order to be deductible. So if you're planning on giving $5,000 a year to something, then do it to a donor advised fund and put $50,000 in there. That way you can get that income tax deduction, and then the donor advised fund can make those $5,000 a year payments to the charity as you direct the fund. You can also use a charitable lead annuity trust. That's something that could possibly be eliminated in the future. You can do that today. It'll make payments to charity for a number of years. Whatever's left at the end of that term can pass to your descendants free of gift and estate tax. So that's a nice planning technique that you could use as well, using a charitable lead annuity trust.
Yeah, Brandon, before I forget, I had a video meeting with a new client, and he has a lot of income this year, so he wants to give $500,000 to charity. And one of the things he asked me about is, should he use a charitable lead annuity trust? So if you would run the numbers for us, what he would like to do is put $500,000 of appreciated securities into the charitable lead annuity trust, have that pay out to public charities that he's chosen over a period of, I'd like to show him 12 years and I'd like to show him 16 years, so that it's 100% charitable income tax deduction. Assume equities are going to grow at, I would like to show it at 7.5%. And what would be left in the CLAT to pass estate tax free for his children at the end of that 12th year or that 16th year. And I'd like to show that without any discounts, because I think he wants to put 500 worth in and get a $500,000 deduction. But I also would like to show him if he puts 750 of appreciated assets into an LLC and transferred the non-voting member interest in that to the CLAT, what that result would be for his children. And what we can do is next week we can come and show that to the audience. But it was interesting. He comes from an accounting firm background, so he said, well, if I'm going to do 500, shouldn't I do it in a CLAT? And I said, boy, I should have thought of that. That's the Grantor CLAT. If you are sincerely concerned that you want to use more than half of your 11.7 million exemption, so that in case the exemption goes down without notice, but you're also concerned that you might have to pay a gift tax if they retroactively reduce the exemption, you could use a QTIP trust, a lifetime QTIP trust for your spouse, and that would give you the flexibility to decide next year whether you wanted that to be a gift of part of your exemption or whether you wanted to just pass out to your spouse using the marital deduction. So Brandon, number 18, should I hold off on paying my property taxes if I'm limited to 10,000 deduction this year for property taxes, interest, expense, etc. But next year it may become unlimited because those SALT limitations probably are going to go away.
Yeah, so there's a lot of talk in Congress right now, especially from the New York and California representatives, of trying to eliminate the deduction or the cap on your state and local income tax deduction. So historically, I think before 2017, whatever you paid in state and local taxes, property taxes, any state income taxes. Fortunately, here in Florida, we don't have to worry about a state income tax, but we have some outer staters on here that do have state income taxes. You got to deduct that on your federal tax return. Well, as of 2017, you were limited to only $10,000 of that deduction. So if that changes and they do allow for a large state and local tax deduction, then it might make sense to defer the payment of those into 2022. Even if you have some small amount of penalty that would apply. If you pay it in 22, you would get the deduction in 22, even though it might have been due before then. We haven't ran the numbers on that. This is something that Bob Keebler mentioned on his presentation on Lineberg, that it makes financial sense to pay some penalties and interest to get the deduction in 2022, so that way it might be deductible in full rather than just capped at $10,000. So something to consider running the numbers on, talking about with your financial and CPA advisors, and seeing how that works out for you.
Yeah, I think another thing that we're going to do for the next few weeks is when clients call and say, I want to do an S corporation, don't make the S election yet. You've got plenty of time to make the S election. Wait until your time limit is up, because you may not want an S election, because the whole concept that S corporation dividend income is not subject to employment taxes may go away. We don't know. So just try to stay, I think we try to stay more flexible. And we don't know what's going to happen with Section 199A and that 20% deduction. We just don't know yet. So sometimes it's better to wait a few weeks now, as opposed to jumping into a structure if you're in the middle of a restructuring. The CLAT can be fully tax deductible as if totally charitable, even though what's left in the CLAT after a number of annual payments can pass to your family. A CLAT can be done during your lifetime or upon death, and it can be funded with part ownership of an LLC. And the correct answer is all of the above. Now, I wanted to mention that our good friend and hero, Sandy Glazier, who is such an authority in so many areas relating to trust and tax law, did a YouTube video at my request. It's about 20 minutes and it's on our website, and she has great materials. So she goes into a lot more detail relating to these new tax rules. She has a Steve Lineberg article. So Brandon, anything else you want to mention? I know we've given the readers a lot of pages here. But is there anything else that we should mention? We do have our Lineberg message number 2873 on the Bernie Sanders bill. And, you know, that's probably worth reading for those of you who are interested in the estate tax aspects of this. And then we have material on the Biden two-step. And I think most people on this webinar know what the Biden two-step is. First, you put your assets into LLCs, set up an irrevocable trust, give the trust some ballast capital, and then sell a limited liability company interest to the trust for a note, and then decide when you're going to cancel that note. So a second question here. The Biden two-step involves A, transferring assets to a trust in exchange for a note, B, forgiving the note if the estate tax exemption is going to be reduced, C, Joe Biden's dance moves, and the correct answer is D, both A and B. So Brandon, what do we have on page 74?
Yeah, so this is just a recent client that came in with, you know, just asking us what they would do as far as planning goes. And it was a little complicated because husband has a short life expectancy, has some health issues going on, and we wanted to fund a SLAT for the wife, so then the wife could benefit, you know, from that trust and therefore not have to worry about running out of any type of assets. But if you see husband's assets here, he has a large IRA, can't put that into the SLAT, that's got to stay out. Has variable annuities, which might be able to go to the grantor trust and a SLAT without triggering income taxes. That's a little unclear, but we think the law would allow a transfer to a grantor trust without triggering the income tax in the annuity, but something to be careful about when you are planning with variable annuities. But the other question is, what do we do with this LLC down here that has $6 million? It's owned by the wife, so the wife can't fund a trust for her benefit that would be outside of the estate. So if they did absolutely nothing, and the exemption were to go down next year, you can see at the bottom here, and it's blank, but the actual estate tax amount would be $1.3 million. There'd be no portability allowance. Wife might die in 10 years, leaving a large taxable estate and some estate taxes. If there's no change in exemption, there'd be no estate tax on the first death and some portability, but there would still be a pretty significant estate tax on the second death, giving the growth in the assets. So what could happen here? Well, if we go to the next slide, it shows what we proposed of afterwards. So the first step that we do is, number one, we took their homestead and transferred half of the homestead to the husband and half of the homestead to the wife. And the wife set up a QTIP, put the her half of the homestead into the QTIP. We've talked about QTIPs in prior presentations and how those work. You can Google, you know, our presentations on those, or we might get to some explanations of those in some future slides here. But the basic idea is that you use a small portion of your lifetime gift exclusion to fund the QTIP. You retain the right to live in the house for a number of years. After that, it passes to a trust that could be held for your descendants. You would pay rent for the continued use of the house, which would not be a gift to the trust, and that helps further reduce your estate. So a QTIP could work well for the wife with her half of the homestead. And then the other half of the homestead might go under the spousal limited access trust, and the husband pays rent to use the house to the SLAT. So what did we do with the 70% of the LLC that was under wife's name? Well, we thought about just having wife gift the husband the 70% interest and then funding the SLAT, but that could, you know, run into issues with the step transaction doctrine, substance over form, to where really the IRS might view that as the wife funding the SLAT. So we didn't want to do that. we thought it'd be better if we just had the husband make an arm's length purchase of that 70% interest. So it might be $3.7 million for the 70%, taking into account some discounts. That can be purchased in exchange for a note. The benefit there is now husband owes wife a note, which could be deductible for estate tax purposes. So that helps reduce the value of the IRAs and reduce the tax hit on those IRA assets that cannot be transferred. So then the 70% interest in the LLC goes into a SLAT. The variable annuities go into a SLAT, and half the homestead goes into a SLAT in exchange for a self-canceling installment note. And the self-canceling installment note says that if husband dies before the note term ends, then the note cancels. So in effect, nothing is paid back to the husband. So that's $5.2 million essentially transferred outside of the estate without any payment back to the husband. So what are the results? Well, if the exemption does go down in half, then the husband has no estate tax on his death, has some portability allowance, and there's just a very small estate tax here in when the wife dies in future years, and we've saved around $7 million of estate taxes with this plan. If there's no change in the exemption and husband passes away, he'll have a large portability allowance due to the reduced value of his estate, because the skin's not going to be included in the estate. The only thing he would have included here is the small interest that they retained in the LLC, the IRAs minus the note owed to the wife and their joint bank accounts. So that's around $8.6 million of portability allowance that ports over to the surviving spouse. She dies 10 years later, is able to use that portability allowance, assuming she doesn't remarry and a subsequent spouse pass away prior to her death, and zero estate tax is owed. So that saves around $5.5 million if there's no change in the exemption level, and it does decrease by half in 2026 as projected. So this is just an interesting way to take assets from one spouse to the other when there's to try to fund a SLAT when the husband or the individual that you want funding the SLAT just doesn't have a lot of assets in their name that are able to be transferred into that type of trust. So Alan, any other comments on this?
Okay, well, for the newcomers who are not novices in this area, the main message is the husband is able to put $6 million of assets into an LLC and or have $6 million worth of assets in an LLC and value that at $2.7 million. 70% of $6 million is $4.2 million. Take a discount down to $2.7 million, and then half of his homestead. The homestead's worth $1.8 million, but half of that is $950,000. But when you only give away half a house, nobody wants to buy half a house. So you could discount that a little bit. And then the annuities, we can use an LLC to discount the annuities to some extent. So now, instead of these assets, the husband has a $5,200,000 note, which is going to pay interest at about 5% a year. But on his death, the note completely cancels. So we've taken $7 million worth of assets out of his estate. And in exchange for that, the only thing he's going to receive is whatever 5% payments he receives for the remainder of his lifetime. If he is in good health, we can use a promissory note that's just under 2% if we do it this month. And so when these assets are worth $10 million or $12 million in 10 years, the only thing in his estate is a $5.3 million note or maybe nothing. So that's the SLAT. But what many of us see, and I know there's a lot of mostly tax advisors on here today, you get stuck in a world where your client only has IRAs and only has annuity contracts, and you've got to pay income tax to pull money out of those to make gifts. And I was talking to Jerry Hesh about this, and sometimes the answer is stop deferring the income tax, give away the stuff that you can discount and give away, the stocks and bonds, and go ahead and start living off of the annuity and go ahead and start paying the income taxes, because somebody's going to have to eventually. and maybe start taking money out of that IRA once you're 59 and a half, spread it out, because somebody's going to start paying tax on that eventually, and that IRA gets subject to estate tax, even though it belongs 40% to Uncle Sam. You know, if I die and my daughter and my wife are in the 40% bracket and they eventually pay the tax, I look at that like 40% of what's in that IRA belongs to Uncle Sam. But if I die, they've got to pay the estate tax on Uncle Sam's share of that. Now, for those of you who are stuck in the annuities, if those annuities cost, say, 800,000, they're worth 2 million. The first $1.2 million you pull out is taxable income, but you could divide that variable annuity in half, for example, where it would have a $400,000 basis and a $1 million value. And then if you wait half a year or so after you do that, you wait 190 days, and then if you liquidate one of those annuities, you'll pay tax only on the 600,000 of growth, or I'm sorry, the 800,000 in growth. So you get to prorate your basis. So, and then can I give a note to my spouse in exchange for an asset? Is the note genuine? Well, in this situation, you do have a little issue because the husband is judgment proof in Florida. The IRAs are creditor proof. That's all he's going to own. But he is going to own this note back, this self-canceling note of $5 million too. So he will have a substantial net worth while he's living. When he dies, that $3,750,000, is that going to reduce his his estate for estate tax purposes and increase his wife's portability allowance? We hope so, but you can't be sure of it. Because while it is, I believe, a legitimate debt, if his estate can't pay it, I'm not sure exactly how that comes out. Brandon, any comments on that?
Yeah, no, I think that's all. I mean, this is, I would say, a higher risk plan, but the clients are comfortable with the risk, given that it's something that could work. It's something that might not work, but I don't think there's any harm done by implementing the plan and seeing what happens. So it's a good way to get some stuff done now before there's potential changes here, and then see how the results turn out.
Quite frankly, a lot of clients come to us with these variable annuities. They bought them for the income guarantees, and the income guarantees don't work nearly as well or as expected. A lot of times the people who sell the annuities don't understand them. If you go to YouTube and Google Gassman annuity variable or Gassman Notre Dame annuity, you'll see a presentation I gave at the Notre Dame Tax and Estate Institute a few years ago. A lot of these annuities can be rolled over into very low cost variable annuities and kept in bond funds or fixed income, while the equity portion of the investments of the clients are in a more efficient place. So we see a lot of people that have these annuities. The annuities have performed fairly well, but you can reduce the costs. And if anyone wants my white paper on that, just go ahead and send us an email and we'll be glad to send it.
Yeah.
So Brandon, anything you want to mention in particular that comes to mind from this list?
Yeah, I think it's, we mentioned it earlier, but if you are planning on doing any type of estate planning involving an irrevocable trust, do it tomorrow if you can. Get these plans done and taken care of, because there is possibility that it could not be available in the future. So I think just act while you can. If you are considering it, it's just another reason to go ahead and do the estate tax planning that you've been putting off and delaying. Let's go ahead and get these items done and taken care of if you are estate taxable.
Yeah.
And,
okay.
And one good question here before we move on to a different topic, and related to the IRAs and you talking about income in respect of decedent. The question is, I take it that giving an elderly parent a general power of appointment over an IRA won't work. And the answer to that is that's correct. It won't work because you don't get a basis increase in income in respect of decedent assets. So all the income taxes on the IRA are still going to be owed regardless of whether anyone held that power of appointment. Now, for other types of assets, say you have stocks, bonds, or S corporation stock, or some sort of business entity, you can give an elderly person a power of appointment over those assets and trigger a step up in basis. Now, you need to be careful because that's going to include the assets in their estate. So we wouldn't want to, give someone a power of appointment to get their estate over the actual exemption amount. But if they have little to no assets, then that type of planning can work really, really well for income tax purposes to give a step up in basis and be able to redepreciate assets and have that gain eliminated.
So one of the greatest hits we have here, and a gift for you, is the Estate View spreadsheet. And this spreadsheet was programmed so that you can be an idiot and still use it. So it works very well for me. And what we have here is a single individual. And if you're single, I could introduce you to this person. They're very nice. And in the green here, we have the present estate tax exclusion, 11,000,007, and it's scheduled to go to half in 2026. So we're showing that each year. And then we show that Bernie Sanders would reduce it to 3,000,005. And what we have here in the middle is somebody who starts off with 5 million net worth, growing by $7,000 a year. And on the right, we see that this person, if the exemption stays at 11,000,007 and goes up with inflation, they're not going to have any estate tax problems for 20 years. So in 20 years, they can go see Brandon, because I'll be 82 years old then, but they can go see Brandon and talk about the estate plan. The estate tax exemption going to half, though, they have a problem in 5 years. And if Bernie Sanders' bill passes, they have a problem immediately. But what we've been able to do here for you, so that you can see how this would work for yourself. If you're married, first you'll have to get divorced in order to use this spreadsheet. Might be worth it. If you're weighing that question, should I get divorced? Well, I could use Alan's new spreadsheet. But what you can do here is you can say on the arrows, well, what's the asset growth? I'm at 7%. Well, I think I could do 9%. Okay, increase it to 9%. And then what's my net worth? 5 million, where I forgot to tell you about that stuff that I got from my grandfather. It's now 6 million. And by the way, I'm able to save 70,000 a year for the next 7 years. So now this tells you where your issue will be. And for those of you who are financial advisors, just showing somebody these middle white items of, hey, here's what you have today, here's your growth rate, here's what you can save a year, and here's what you'll have in 15 years if you could do this. If you could keep your cost of investments down so you have a reasonable growth rate, if you can keep saving, you'll have $19 million in 15 years. But you know what? If you don't save anything, then in 15 years, you'll only have 16 million. So that's one spreadsheet we have for you. The second spreadsheet we have is maybe you're single and you should get married. So if you're single and you would like to use this spreadsheet, which shows all the numbers double as much, then that would be a reason to get married. Any comments on that?
Yeah, no, I think it's, another aspect of this is a lot of people don't think that they have an estate tax problem. And then you can show them this spreadsheet and say, yeah, you don't today, but 5 years from now you will. And there's benefits to doing this type of planning sooner rather than later, because the longer you can have assets held outside of your estate, that growth that's passing outside of your estate is just more advantageous. So it's an important piece of the puzzle to just run some numbers and see where you'll be in 10, 15 years.
So under the reciprocal trust doctrine, if I set up a trust for Marcia, which provides her benefits for health, education, and maintenance. She can be the trustee. She can direct where it goes when she dies. It's not going to be subject to estate tax on her death. It's not going to be subject to estate tax on my death. That's the SLAT. And now Marcia would like to set up a trust. And to my surprise, she would like for me to be a beneficiary of that trust. Well, under Florida law and the estate tax law, I cannot set up a trust for myself that I benefit from. If I do, then my creditors can reach into it. And if my creditors can reach into it, then the IRS can impose estate tax on it when I die, because I could go run up a bunch of debt and have the trustee pay the debt, and that would be a benefit to me, and that just doesn't work. So I set up a trust for Marcia. If Marcia sets up a trust for me, then under the tax law, if the trusts are very similar, then the court will say, really what happened was Alan set up a trust for Alan and Marcia set up a trust for Marcia. We're going to uncross them. And therefore, Alan's trust is subject to estate tax when he dies. Marcia's trust is subject to estate tax when she dies. Now, there's a U.S. Supreme Court case, I think it was U.S. v. Grace, and the Supreme Court, I thought, was very generous and said, if the trusts are somewhat similar, but there's differences in them, like one allows income only to come to the spouse, one gives the spouse the power to direct where it goes, the other gives the spouse only as needed for health, education, and maintenance, the spouse has no power to redirect where it goes, then the reciprocal trust doctrine doesn't apply. But what the Supreme Court was not told and didn't think about was that there's another reciprocal trust doctrine in the creditor law. If I set up a trust for Marcia and Marcia sets up a trust for me, and a creditor goes to a judge and says, don't you see what really happened here, Judge? He set up a trust for him, she set up a trust for her, so I want to get in. And the bankruptcy courts and the civil courts are not going to be as generous as the Supreme Court was on this question, because creditor law is different than tax law. So what happens is I could draft the most beautiful reciprocal trusts for Marcia and we could follow US v. Grace to the T. But because these trusts are in Florida, I'm afraid that because a creditor can reach into them under the tax court case of US v. Brown, then the IRS can pierce those. So we don't do reciprocal trusts. And if you're going to try to do one, you're going to want to do them in a creditor protection jurisdiction and try to be very, very clear that creditors cannot reach into that trust. Because if you live in a non-creditor protection trust jurisdiction, like Florida, and you form a creditor protection trust in a state like Nevada, there's a risk that Florida law will apply and not Nevada law, because no one knows exactly how that's going to work under the full faith and credit clause of the US Constitution. And I'm really surprised that nobody signed off the webinar during that long, boring description of our concerns under the reciprocal trust doctrine. Let's see here. The tax exclusive nature of the estate tax, I'll only say that if you're going to be subject to estate tax and you make a large gift and you pay the gift tax and you live at least 3 years after making the large gift, your family will come out ahead. So if you are going to risk making a large gift, for example, you put $15 million into an LLC and you transfer a 99% non-voting member interest in the LLC to a trust for your spouse, and you call that a $10 million gift, the IRS comes up and says, no, it was really a $12 million or $13 million gift, pay us some gift tax. Well, you shouldn't have to do that if you use a formula clause on your gift. But even if you do, just know that paying the gift tax while you're alive saves a lot of estate tax, because the gift tax you pay is not subject to estate tax, whereas what you use from a dead person's estate to pay the estate tax is not deductible on the estate tax return. Brandon, and by the way, you can't just put these assets in the LLC and the next day sell the 99% non-voting member interest in the LLC because of the Senda case, SENDA, which I think is wrong and I wish it was appealed. But the court said when you just put something in a limited partnership and then you immediately transfer the limited partnership interest as a gift, it's equivalent to a gift of what you put into the partnership. So you have to wait a reasonable period of time between funding the LLC and making the transfer. In the Holman case, the court said it was fine to wait at least 6 days, but the asset was highly volatile Dell stock. So the Holmans got away with waiting 6 days. We like to wait 20 or 30 days if we can. So if you're going to be doing this type of planning, the first thing to do is put your assets into the LLC, or if you're going to use a limited partnership, while you're still working with the trusts and all that stuff, get the LLC set up and funded if you think you might have to move quickly. Now, one of the things we run into a lot is the decision making with respect to what needs to be reported on a gift tax return and what you should report on a gift tax return. And Brandon, do you want to cover this?
Yeah, so the technical rule is anytime you make a gift over $15,000, you're required to report that on a gift tax return, show what the value of the gift was, include the appraisals of the gift if it's a hard to value asset, and report the use of your exclusion. So then the real question becomes, well, what if I make a sale to the trust? That's not a gift because what I got back is equal to what I put in. So I didn't make any type of gratuitous transfer. Now, when we do those types of sales, we do have to fund the trust with a seed capital gift, generally around 10% of the sell amount, because we want the trust to have kind of its own independent net worth, the ability to have some cash to make the interest payments on the note, just to make this look more like an arm's length legitimate transaction. So that gift will have to be reported on the gift tax return using a portion of your exclusion. Funding the LLC, that doesn't necessarily have to be reported. A sell for a note where you're equaling the fair market value of the asset sold, that does not have to be reported because it's not a gift. The question is, do I want to report it? If we fully disclose the transaction on the gift tax return, give the IRS copies of everything, including the appraisal, and wait 3 years, then the IRS can no longer audit that transaction because we have fully disclosed it on the gift tax return and the statute of limitations runs on that. If you don't disclose it, then you're not running any statute of limitations and it's going to be audited possibly on death when a 706 is filed. So the clients ask us all the time, what's better? What should I do? We generally prefer just to not disclose the sell transaction. And most clients prefer that too. They say, look, this is my kid's problem. It's not going to be my problem. If the IRS happens to audit and challenge this, our kids can take care of the estate tax in 20, 30 years when I pass away. But there are a lot of people that do disclose sells on gift tax returns, so it's optional. It's up the decision that needs to be discussed with the client, but you can give them the pros and cons on that decision. And then the last one here, the cancellation or gifting of the note. We're doing a Biden two-step where we would sell assets to the trust in exchange for a note. And then step 2 for giving the note, that's going to have to be reported on the gift tax returns. Alan, any further comments on that?
No, but whenever we say that sometimes the right answer is not to disclose this on the gift tax return, I'm always afraid that lightning's going to strike me because so many people in our profession industry say you really, really should always disclose it. But and you should really always get a $20,000 valuation appraisal of your business. And the client just says, look, I'll do this, but I don't want a $20,000 appraisal of my business. I know what my business is worth. I'll come up with a consultant's opinion of what maybe a business broker would sell my business for. I'll just use that. I'll pay $30,000 to get someone to tell me what the discount is. I don't want to go through an audit, so leave that to my kids. Just, there's different points of view on this, but I'll point out that the standard of practice, according to many authorities, is to disclose everything and get valuation opinions on everything. And the joke is that, you know, always tell your clients to get a valuation opinion because it'll make your legal fees look smaller. But sometimes brokers know as much about value as investors do.
Yeah, and I think another point to make there is a lot of people prefer disclosing it on the gift tax return versus an estate tax return because the audit rate for gift tax returns versus estate tax returns is much lower. So they think they can slide more things through on the gift tax return versus an estate tax return. The other consideration there is, particularly if you're doing it for a self-canceling installment note, is will there ever be a 706 filed, and therefore will it ever be disclosed to the IRS? So those are all things to take into consideration as part of this analysis as well.
Right, and the goal here should be zero estate tax and zero filing of a Form 706 estate tax return if you get the client under their exemption amount. So for example, that family we showed you, they're not going to have to file an estate tax return unless they want to, because we're going to keep both spouses under that 11.7 million exemption and under the 5 million exemption. Maybe when that husband dies first, we will file that estate tax return to get the portability allowance. That's going to assure us that we're not going to have an issue on the second death. But for your single clients, if you could convert enough of their assets to self-canceling installment notes and private annuities that vanish on death, then you're not going to have an estate tax return. So there will not have been any, you know, harm done on the gift tax side, because I have never seen an estate tax audit of anyone who has not filed an estate tax return. So what is a SLAT? It's a spousal limited access trust. We call it defective if the grantor is the one is a spouse, and then the trustee is the spouse of the grantor. Then it will be disregarded for income tax purposes, and that can continue. If you want to toggle off that grantor trust status, if it's possible to, because it's not clear whether it is, then you would need to have a provision in there that another beneficiary would have to approve any distribution to the spouse. So that's all of the above. That's one of the technical reasons that you should not go to LegalZoom and try to do a SLAT on your own. Not that I think that that's available. Now, the lifetime QTIP trust, just to point out, we've got the literature here. The client would like to use up the 11 million exemption, but would like to get it back if it's not needed. So the client puts $11 million into a qualified terminable interest trust. This has nothing to do with earwax. And the trust is going to pay all income to the spouse, but it may not have much income. And next year, the client can elect to either make a marital deduction election, in which case the trustee of the trust can give all the assets to the spouse and it's like you never had it, or can elect not to have this be considered to be a marital deduction gift, in which case the QTIP then is held for the health, education, and maintenance of the spouse, pays the spouse income, and you've used your $11 million exemption. So if you're concerned at all about the situation, whether there could be a retroactive reduction in the exemption amount, this would be the solution for that.
As far as what's going to happen with the tax law and what direction we're headed. So, I think putting structures in place that are flexible and can go one way or the other, and not locking yourself into one position is going to be the theme going forward for, I'd say, at least the next couple of months until we get a clear path on where Congress is going to go on tax changes, which I think will happen. It's just the question of to what extent that they will happen. So we'll just have to see what goes forward, but flexibility is just going to be an important piece of this.
Right. So again, thank you very much for attending this presentation. We always welcome your questions, comments, and suggestions. Please keep them coming. and have a fantastic day.